Hello and welcome. In this lecture video, I will be talking about admitting new partners. Okay, so look over here. This is on page 298 of your course pack. When a partner is admitted, the existing partnership ends, and that's also true when the partner withdraws, and I'll talk about partner withdrawals in the next lecture video. The partnership will continue to operate as a new partnership consisting of the remaining partners. So the old partnership ends, and then there'll be a new partnership. Okay. How can we admit a new partner? Well, there's two different ways. The new partner can purchase interest from an existing partner, or he or she can invest cash and assets into the partnership. Okay. So let's look at the first situation where that partner purchases an partnership interest from an existing partner. Okay. That's going to be a personal transaction between the new partner and then the existing partner. Okay, and then the partners, of course, must accept that new partner. Okay, and so in terms of our journal entry to account for this, right, all we're basically going to do is account for the purchase of the partnership by reallocating some of the current partner's capital to the new partner. Okay, so let's look at this example. It says here on January 4th, Hector Perez sells 1/2 of his partnership to Rashid for $18,000. Perez gives up $13,000 recorded interest in the partnership. Record the transaction. So on 1/4, look over here, we're just going to reallocate some of Perez's capital to Rashid. Okay, the cash that Rashid paid Perez, that's the personal transaction. Okay, in terms of the accounting, we're just going to allocate the capital. But the cash, because Rashid has to pay Hector for the partnership interest. And so he's going to pay him $18,000 cash, right? But that cash, right, is between Hector and Rashid. We don't record that within the partnership. The only thing that we record in the partnership is that Perez is giving up $13,000 of his capital to Rashid. So, how do we decrease capital? With a debit, because capital is equity. How do we decrease equity with a debit? How do we increase capital with a credit? So we're going to debit Perez capital for the amount, $13,000, and then we'll credit Rashid capital for $13,000. Okay? So, debit H Perez capital, $13,000, and then we'll credit Rashid capital for $13,000. Remember, this $18,000 cash that Rashid is paying Perez, that is a personal transaction. That's the personal transaction. Okay? What we do in terms of accounting for the partnership is just move the capital balances based upon the interest. Okay? All right. So let's look at our capital balances after admitting Rashid. So we can come over here and we can see, remember, Kayla had the 52. Perez initially had the 26, and then we decrease his by 13, and then we allocate it to Rashid. We can see that the total, look at the total capital before Rashid and then after Rashid. It's the same. It's just moved around. Okay? So that's what I'm saying up here. Partnership assets, liabilities, and total equity are unaffected. And of course, both partners need to agree, right? And then when they agree, they'll do a new partnership agreement that's going to specify income and losses. Okay? And if they refuse, Rashid gets Perez's sole share of the partnership, income or loss. Okay? And Rashid will not get a voice in managing the company unless he's admitted as partner. Okay? All right. Let's talk about the other situation. So this was the situation where one partner just sells his or her interest to a new partner. Let's talk about the situation, though, where Rashid says, I can bring cash or other assets to the partnership. That's a different situation. So not buying part of the existing partner's interest, he or she is bringing new assets to the partnership, okay? Contributing new assets to the partnership. In that case, that will increase the partnership's total assets, okay? Total assets and equity, okay? So let's look at our example. So we say over here on January 4th, Rashid is admitted to the partnership with a payment of $22,000 cash. Let's record that transaction. Okay, so come over here. We're going to, on 1/4, we'll debit cash for $22,000, and then we will credit T Rashid capital for that $22,000. Now this does increase total assets, the left side of the accounting equation, and this increases total equity, the right side of the accounting equation. So remember, before Rashid we had 78, and now total equity, total capital, is increased by 22. So now we have total capital now at 100,000. Now that doesn't mean that Rashid necessarily has a 22%, a right to 22% net of 22% of the income or losses. That is a separate matter discussed in the partnership agreement. Okay? Let's talk about a situation where the current value of the partnership is greater than the recorded capital, recorded equity. And so what that means, right, is that the partners say to a new partner, to Rashid, for example, you want to come in, you have to pay a bonus. So Rashid really wants in, and then he, for example, might be able to say, well, I'll pay $22,000, but you can see that's 22% of the new, but rather than getting 22% right over here, I'll just take 10%, 10% new equity, right? So what's going to happen, right, is he's going to pay more cash than his equivalent interest in the partnership. Why would that happen? Well, the current market value is greater than the recorded equity. Okay? So let's look at our example. So on January 4th, Kayla and Perez agreed to accept Rashid as a partner upon investment of $42,000 cash, but Rashid gets 25% interest. Okay? So I feel like I'm on Shark Tank here. If you ever watch Shark Tank on CNBC, that's what this is like. Okay? That's what this is like. So we can come over here. How can we figure this out? So we're going to say our equity of Perez and Zahn, which is equal to our $78,000. That's before admitting Rashid, and that's what we saw on the prior page, right? $78,000. And then we say investment Rashid is our $42,000. That's how much cash he's bringing to the partnership. Okay? Then we can say our total now becomes a 78 plus 42, which is our 120. Now Rashid gets 25% of that 120, $30,000. Okay? So now we can look at the full journal entry right over here. And we can say we're going to debit cash for the amount of cash right here, $42,000. And then we will credit, of course, T Rashid capital for this $30,000. Now you can see our debits don't equal our credits, right? Well, what's going on is that Rashid's only he's putting $42,000 cash into the partnership, but he's only getting $30,000 equity. Now, why would he want to do this? Because he really wants in. And then the existing partners, Perez and Zahn, are saying, well, if you want in, right, you have to give us this much cash, but we're only going to give you this much ownership interest. And so now this difference of $12,000 goes to Zahn's capital and Perez capital. And it's split equally. That's what I'm saying right over here. Okay? So that means we can increase Zahn capital by 6,000. And I'll come down here, I'm running out of room. H. Perez capital also gets credited for $6,000. Okay? So, and then now we bonus. And the way I got that 6,000 is I took the 42 minus the 30, which gives me 12, and divided by 2, $6,000 each. Okay? Let's look at the reverse situation where Kayla and Hector really want to bring on Rashid. Okay? Maybe Rashid has some skills. They really want to bring him on. And Rashid says, well, okay, that's fine, but I only want to put up $18,000 cash and I want this much ownership. Okay? So in that case, right, we have a bonus in terms of equity that goes to Rashid. All right? So here, Rashid says, I'm going to put up $18,000, but I want 25%. So we'll do the same thing here that we did up here. We'll say our equity, Zahn Perez, which is our 78,000, plus our investment of 18,000, right? Which gives us our total, this will be our total capital of 96,000. And then we say he gets 25%, Rashid gets 25%, so we'll say Rashid is 25% of the 96, which is 24,000. Okay, now we can do our journal entry. I'm going to flip the page over, okay, because I'm running out of room. So we'll debit cash for that 18,000 that Rashid is investing. And then we will credit Rashid capital for the 24,000, which is how much ownership interest he gets right over here, the 24,000. Okay. Now, we can see that our debits don't equal our credits. What do we need to do? We need to decrease Kayla's capital, and we need to decrease Hector's capital. Well, by how much? 24 minus 18 is 6, right? And so we're going to split that 6, 3 and 3, between Hector and Kayla. How do we decrease capital? With the debit. Why? Capital is equity. How do we decrease equity? With a debit, because it's on the right side of the accounting equation. So I'll debit K Zahn capital, 3,000, and then I'll debit H Perez capital for my 3,000. Okay? And then that's my journal entry. And that would, of course, be done on January 4th. Okay? Done on January 4th. So, sorry, I can see my document camera is struggling to focus. There we go. Now we have focus. So, debit to cash, debit to Zahn capital, 3,000, debit to Perez capital for 3,000, and then debit to, credit to Rashid capital for 24,000. That would be our final journal entry, okay? Final answer. All right, so I'm going to end this lecture video now, and then the next lecture video we'll talk about withdrawals of partners, okay? When a partner wants to leave the partnership. That's the journal entries we'll talk about next. Thanks so much. Bye.